Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 14th of June. I'm Daniel Lam, your host for the podcast. One of the most telling pieces of analysis that I came across lately was the chart of the correlation plot between the S&P 500 and the US CPI index. Now in 2022, this dipped to its most negative level over the past 10 years, but since then have been gradually turning back upwards, i.e. back in 2022, there were sharp moves in US risky assets, such as US equities, on the day when US CPI figure came out. That effect has been diminishing. Now, we all probably already knew this, but seeing this in picture was still extremely striking. And now, last night's CPI print confirmed that inflation was less of a threat nowadays because the predictability of CPI has returned back to pre-COVID levels. The monthly growth rates of headline and core CPI were both consistent with expectations at 0.1% and 0.4% respectively. And the details of the report point towards softer readings going forward. Now, specifically, the two main areas of strength in the report were shelter, which grew at a monthly rate of 0.6%, and used vehicles, which grew at a high monthly rate of 4.4%. Now that said, the consensus is for the inflation rate of these two items to be dropping in the coming months. Moreover, if you exclude shelter and used vehicles, the supercore CPI was only up 0.1% in May and is trending at an annualized rate of 2.3% over the past 3 months. So overall, this newest CPI report likely means a no-hike outcome at the FOMC meeting later this week. But there is the possibility that the Fed may mention the option for a hike in July due to the still relatively strong labor market. But overall, taking all these into account, investors are still likely to be staying with their quote-unquote comfort zone in US equities for the very short term. Growth data is key now. It is what can move the markets. And you need to see a series of underperforming US growth data vis-a-vis the expectations that have been revised up over the last few weeks in order to change this comfort zone narrative. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.